Good afternoon, ladies and gentlemen. It is Sunday, the 17th of October, 2021. Welcome to Hindsight, episode 21, where we learn to be a better trader. As always, this video should not be taken as financial advice. Consider it as education and entertainment purposes only. Any stocks I talk about is not a recommendation to buy, sell, or do anything in particular. It's just simply my commentary on what's happening on the markets lately. So, we're going to take a look, first things first, at uranium. Now, I haven't made any content lately because, well, there's not much to talk about intraday. Really, it is just a bunch of range breaks, and we'll go over some range breaks that have happened, particularly on uranium, because those are the sort of standout trades that have been happening. But intraday match trading is dog shit lately. I think all of you can see that. Match trading just isn't that exciting. It's not that interesting. The order book doesn't really work that well anymore, at least in the opening minute or so. We have candles that wick about up and down, so it rarely just opens and rallies or opens and dumps. Very rare to see a good sort of pre-market setup to take the match trade, so really it is all about finding that range break in the first 15 minutes or so. At least that's what I'm finding. So we're going to talk about uranium first and foremost, and then talk about Flight Center a little bit. Now, uranium is a bit of a soft spot for some people. They get triggered if you discuss shorting it. They seem to be a real sensitive bunch of holders, so I thought this deserves its own introduction. Now, uranium is a stock that it's a commodity that I've been trading for the last 5 years or so, in and out, usually on the speculative end at least once a year. You know, there's always some sort of fundamental push that drives it for about 4 weeks, and then it dies off into nothingness. So you can browse stocks like POW on my Twitter feed and see what I've been trading and why I've been trading it in the past. And really, it's about finding the sector that's hot, riding the rally, and then just getting rid of it and not touching it until the next sort of thing comes along. I think the last uranium pump was to do with Trump, I think back in, I don't know if that was the 2021 or the 2018 one, where Trump signed some sort of nuclear deal or something to do with nuclear energy. You know, there's always something that causes uraniums in the uranium stocks in the speculative end to rally. So stocks like 92E, we're basically talking about anything sub 100 mil market cap. But what we have here is the uranium ETF, and this is where all the speckies started to run, and that's really on the back of this move here. And let me just change that color. So what we have is uranium spiking, uranium speckies spiking on this breakout. As you can see, it's been on a pretty slow and steady grind for much of 2020 and 2021. So it hasn't got that much attention in the speculative end because it just hasn't done anything too exciting. It's just slow, steady, and trending to the upside. And you can see exactly why it's not that exciting. You know, the ETF for uranium and the spot price as well, of course, has just been tanked since the last 10 years. So this little grind up here in the last 2 years isn't that significant. I mean, what did we hit? We hit the previous highs of 2017 and 2018 quite recently. We've had a breakout, pullback, and then speckies started to get interesting. So as a result, I decided to do some research on something like PDN. And what we have is PDN breaking out here in this horizontal, breaking range, and then catching the long to the upside, but then really touching some sensitive holders who claim to be multi-baggers once they discovered that I'm holding short. Because I watch the markets every day. I watch stocks like PDN every day during a hot sector environment. So obviously uranium broke out, uranium's hot, I'm trading uranium. No one seems to care when I go long on a stock like PDN, DYL, 92E, no one cares. But the moment I go short, some people get some sensitive nipples, and it's like I'm rubbing someone's chafed nipples. They're just really sensitive and they don't like it. They get a bit aggressive. So shorting it from just above $1 and just below $1, I'd say the average was somewhere maybe 101 roughly, and just holding that short to the downside because it feels like Sharesight in a way, like Andromeda Metals, ADN, that one sort of pumped and tanked. So once I sort of looked into the fundamentals of PDN, I wasn't impressed at all. It's basically a stock that, in my opinion, is simply just holding a bunch of land with some uranium on it. They've got one mine that was previously operational, so the Langer Heinrich mine. It's got about a 17-year life of mine. All-in sustaining cost, the last I checked, was somewhere around $40 to $45 US a ton. Could be a little bit off on that number. But basically, that is the break-even point, right? That is the point where they make a $0 profit and $0 losses, around that sort of mark. And then, that's a 17-year life of mine. The mine's currently turned off. It's not functioning at the moment. It's going to cost money to turn it back on and then get things ramped up. And the question is, will the uranium price hold on or even rise in that time? Now, people will forward sort of blog posts, articles about uranium shortages, articles about anything to do with uranium that sounds bullish, like a supply issue. The thing is, as someone who's traded uranium for the last 5 years or so, I've seen this shit over and over and over and again. The only thing that's different, funnily enough, is the people sharing the content, because what they do is they buy uranium, they hold it for a year or two, then they fuck off because they realize that it's actually garbage and it's not going anywhere. So what we have here is uranium moving because of Sprott Physical Uranium, which is basically a fund that's just constantly buying uranium. And people seem to think that this may legitimately corner the market. Now, I think silver was a commodity that was attempted to be cornered at one point in time, and that didn't work out too well. Basically, no commodity has really ever been cornered by a market before, and I don't think a fund is going to change that at all. I could be wrong. Uranium might shoot to $100 in the next couple of years. Whatever. I don't care. What I care about is the fundamentals of PDN. I have no issues with uranium. In fact, uranium overall isn't too bad when you look at the net emissions that are produced. So I think uranium isn't the best that there is, because obviously the uranium itself doesn't produce any carbon dioxide. And if it does, it's very little. But people seem to neglect the fact that it takes about 10 to 12 years to build the mine, and the amount of CO2 produced from that alone is fucking insane. And then you sort of, you look at the net emissions over the next 30 years of the life of the reactor, and you're like, well, is it really green energy? And the answer kind of is, well, kind of. It's better than some renewables, but not all of them. So I have no issues with uranium. My issue is with PDN's valuation. Now, what we have here, and I think this is a perfect response to the latest uranium push. So what we have is the breakout here. Of course, it makes new highs, and this is the uranium ETF, by the way, because the spot price is also moving to the upside. So what we have is uranium, the valuation of uranium rising, and what we have is a retest of the highs here on uranium, and then PDN going, hold on, well, this is actually probably not worth going long on, because when you look at the fundamentals, and I'm not going to sit here and tell you that it's definitely overvalued. That's just my opinion. I think that the valuation of PDN at above $2 billion is fucking insane, based on what they have, based on the life of mine, based on the existing mine that's there and the all-in sustaining costs. I don't see $2 billion there. I just don't see it. I think it's fucking insane. The valuation, I can see other goldies and copper plays that are sitting at around 20 to 30 mil market cap, and and then you've got a bunch of other really good tenements that sit around the 50 mil market cap range, and then you've got PDN that has, I think, just off the top of my head, 3 to 4 tenements with uranium, right? And it's like, last I checked, the grades weren't actually that good either, and neither were they good on the Langer Heinrich mine. So the grades aren't good. The tenements don't look that great. If I recall, one of the tenements is about as good as the Heinrich Langer mine. Sorry, Langer Heinrich or Heinrich Langer? I keep fucking forgetting. Anyway, yeah. So and that mine itself is also low grade, and I just don't see PDN. I don't understand how people see the value of this company. I think it all hinges on the back of a rising commodity price, and that is of uranium itself. Now, again, the only thing that I'm seeing different is the Sprott price, right? These guys, as a fund, are buying uranium. That's the only difference between this year to last year, the year before that, and the year before that. Otherwise, all this uranium news that you're seeing, that I'm seeing, it's the same shit over and over and over again. It's just different faces, right? It's just another news story. So that's my opinion on PDN. That's my opinion on uranium. take of that what you will, but I have re-shorted, although I was nowhere near the size that I was before shorting the top here. It did end up closing about a third of the position at 69 cents on this one, and then close out the rest on open here for PDN. And I'll talk about the long position as well that I got in this. And this is what I'm talking about when it comes to intraday and the break of range. So of course, if I bring up the uranium ETF, we can see exactly what happened. It sort of tapered off here, and it's just going sideways basically. And then one morning, it shoots up on massive volumes on the 12th of October. Now, holding a short position on this is just dumb, right? So I had to close out the remainder of the position on open and waited for it to sell off. I mean, you don't know which way it's going on match because match trading is just garbage these days, but it was going to be a green day no matter what. That's sort of my bias on this one because of the strength of the ETF. It was so bullish. It was a matter of breaking this range here, which is the opening horizontal. So it starts to trickle one way, starts bouncing, and once it cracks to the upside, it's just a buy straight away from there, and then to 89.5 cents. And that's all she wrote, really. Just ride the momentum on this one. And yeah, that's it. Pretty much, that's the trade. So that's what I've been doing every morning for the last couple of weeks, is range, break of morning range. And match trading is just terrible. I don't like it anymore. At least the market conditions and market environments aren't really conducive to making too much profit on that. I mean, I'm sure there are a couple of people out there that disagree with me. But then again, match trading isn't my strong point. I'm good at match trading only when the market conditions are like fantastic for it, right? I'm not like some pure match trader. That's not. I'm pretty much a master of none. I'll trade a bunch of shit in different ways. And yeah, so speckies are my thing. And match trading is still a relatively new process for me. I mean, I've been doing it for about a year and a half now or so. And I just can't seem to be that successful in low volatility or low liquidity environments. So I really need strong catalyst news announcements and a strong book setup. Otherwise, this is perfectly fine. Catching the breaker range is... It's pretty much no-brainer stuff. You know, if it breaks out to the upside here and then fails, it's just like close it out. Great. And then what I'd be looking for then is just a break of the lows here. So if it fakes out to the upside and then just wait as it heads towards the bottom end, and it's anticipate a short. But something like PDN was very, very specifically a long setup because of the ETF. But this is just an example of my range trading that I've been doing the last few weeks, purely because match trading is so terrible for me lately. Now, Flight Center, this one is interesting. This is the market cap visualization or market graph, whatever you want to call it, since 2016. And as you can see, since COVID, we've pretty much hit pre-COVID levels, and in fact shot up a little bit above it. So almost about $4.9 billion for Flight Center here. So let me just change the color of this. So we hit just under 4.9 billion, which was the highs of 2019. Now, people seem to forget that at this point in time, there was a capital raise, a dilution, so they doubled the amount of shares on issue, or just under doubled, I believe it was. So it really spiked their market capitalization, because if we see on the actual chart itself, we are nowhere near this level here, which is the 2019 high, right? $44 roughly. But the market capitalization is at that level, or very, very, very close to. So do keep that in mind. I think a lot of people are missing this point. So keeping in mind that we're pretty much at 2019 highs, pre-COVID highs, not quite the highs of $60, but still, we're still very, very highly valued. And I just want to show you guys this chart here that I posted on Twitter, and this is the financials. This is the total revenues in light blue. In black is gross profit, and in green is the EBITDA, which is, I guess, a way of saying profitability for the business. As you can see, revenues are going up and up and up every quarter, and this is since 2004. So unfortunately, I can't see the market capitalization before 2016 for Flight Center, but you can see here 2016 exactly. You can see the revenues are going up. You can see the gross profit is pretty stagnant, and as a result, EBITDA is pretty stagnant as well. So we've got a pretty steady stock for the last few years. And then what we have is, of course, the COVID tank. So a big hit in mid 2020, and then of course 2021 as well, taking a big hit as everyone expects. Now Flight Centre, or rather the stock market generally is forward looking. That's just how it works. People anticipate buying a bargain. If we look back here on the chart, so people are anticipating that flights at some point in the next couple years, or travel in general, travel tech, will end up being back to normal or somewhat back to normal. So the market is anticipating from this point in time that things will be relatively normal in the next 2 years, or back to where they were in roughly 2019-ish. So that's kind of the thinking behind it. I think it's still a little bit too early. So let me talk to you about what I'm planning in terms of options plays. Now we can see here, this stock has broken out to the upside. If I get rid of this chart here, we have broken out to the upside. And I think a large part of this is because brokers have pretty much turned off shorting for Flight Centre. Now I've spoken to 2 brokers, and both of them have said that the lender, or the person who actually owns the shares of Flight Centre that lends out the stock for people to borrow in order to short the stock, they're pretty much stopping that, right? So anyone who's currently borrowing their shares, if they close the position, they're holding onto those shares. They're no longer allowing other people to borrow and short the stock. So shorting has been turned off, for at least for retailers. I don't know what it's like for the big end of town, if they can still short the stock. But since that news, and that was a couple of weeks ago, I can't remember the exact date, but it was definitely before the breakout. And you can see the response here. When shorting is turned off, we've broken out to the upside, and I'm thinking that's a little bit crazy. So did manage to catch a lot of this pullback here through puts, so buying options to the downside, and that's really the only other way to get exposure to this stock. Now, if I zoom in, let's say the 3-minute chart, the way I saw this stock, and I've been watching Flight Centre ever since this breakout that happened here. I've been watching it like a hawk every day. I've been trying to make sense of its price action, and I'm starting to get a good feel for it. So what I've been seeing is high volume pops to the upside, followed by low volume intraday fades. So what's going to be reflected in the MACD is a positive divergence. So that's effectively what that is. When a stock fades and sells off on low volumes, but then spikes on high volumes, there's an interest to the upside, and then it just kind of trickles down because, well, I guess buying has stopped, or at least buyers are looking for a better level, especially on low sell pressure. So the only people that are selling the stock are currently owners of the stock, and the only people buying the stock are either people covering shorts or people just wanting to buy the stock. So we can see every time it pops to the upside, it's on high volume or rising volume. So if I bring up the MACD, and I'm sure you guys know if you've watched my content before that I don't value the MACD for any other reason except for positive and negative divergences. So on the 15-minute chart, I think this is very nice and clean as well. So ever since this point in time where it sold off and trickled down, we can see the divergence. We can see the divergence coming through. And what you have is a rising MACD with higher lows and higher highs, and then of course the pop happened. I tweeted this out the day before the pop happened. I said that the positive divergence itself is not a signal to buy. It's not traditionally a signal to buy, and anyone that does buy because of positive divergences is just going to suffer losses, because there's nothing stopping the stock from going lower and lower and lower and creating higher and higher divergences, right? So the only thing the divergence really tells you is watch out. It's telling you where the flow of money is, right? It's telling you it's to the long side. That's what this is telling you. It is that volumes are buying and low volumes are selling. That's what this is in a nutshell. So watching this like a hawk, caught the long to the upside, bought some options as well, closed out the options, my short options that I had around this level here. It was about 2 days before the pop, and that was $22 options. So a couple of bags on that, and what I'm looking for now, and I've got long options as well on this at the moment for $23. Not much, just $1.50 or so, just something to ride this to the upside. Because what I'm expecting is that, and this is all just speculative stuff. What I'm expecting, and this is my thought process, right? There's no guarantees any of this is going to happen. This is just me talking out loud. A bunch of if X, Y happens, then I'm going to do Y. That's what this scenario is at the moment. So on Wednesday, and that is Wednesday the 20th of October, the annual general meeting is happening. Now, from what I understand from the brokers is that the lenders are taking back their stock wherever they can in order to vote at the AGM. What I suspect is after the AGM, shorts will be available again for Flight Centre. Now, based on this technical break, it wouldn't surprise me if this rallied for another day or two. So we've got Monday and Tuesday left to rally, and possibly Wednesday. Now, the question is, how high does Flight Centre go? That nobody knows. But my expectation, or what I'm hoping to see, is Flight Centre to go up. Right? That I'm going to keep this real fucking simple. I don't have price targets, right? I don't think it's going to retest $25. If it does, awesome. Options will do really well on the calls. What I'm expecting is either to buy puts on Tuesday or Wednesday. So that is the 19th of October or the 20th of October, or possibly even both days, right? Maybe I'll scale in. I'll put 1/3 of the position on the 19th, 2/3 on the 20th. But what I really don't quite understand is when shorts are going to be available again. And even if they will be available again, right? I don't know if the lender will give back the shares, make them available for shorting or not. So, this is all just speculation again. So what I'm expecting is to see this price rise because of the technical break, and it'll be really nice to see if this breaks out and then breaks this horizontal here as well. So it'll be really good to see on Monday if we can break 23, break 23.60 roughly. So those are the sort of two key targets on Monday. And then if that happens, Tuesday might be a really good day as well because that's a good clean technical break. And then hell, we might even see $24.50, $25. So my $23 calls will be fucking just fantastic. Now, here's the problem with this, I guess, setup that I'm looking for is options expire on the following Thursday, right? So if Wednesday is the AGM and Wednesday closes at a high, I might be looking for 50 cents to $1 less than that closing price. Let's say it closes at $25 for whatever, a magical close at $25. I'd be looking at puts for $24 for the Thursday. So 24-hour expiry on the puts. Now that is massively degenerate, right? That is by no means something I would ever recommend anyone to do, right? But it's within my risk tolerance. I'll put in, I don't even know what size I'll put in, but I will be buying puts to some extent on the 1 month expiry because unfortunately there aren't 2 week expiry options. Right? There's every month, but not every 2 weeks. So it's unfortunate timing, but that's kind of the plan that I've got is maybe a little bit on Wednesday for the following day expiry, just for shits and giggles, right? If it does another sell-off like this sell-off happened here, and that was on the 6th of October, that's roughly the kind of selling that I'd be expecting after the AGM. And again, this is provided that shorts are available. And of course, there's no guarantee that even if shorts are available, that this happens. I'm just talking through a setup and what I'm expecting to see. And if it fails, it fails. So what? It's within my risk tolerance, but I think the risk is about medium and the reward is extremely high. So that's kind of what I'm looking for. It'd be nice if I had 2 week expiry options so I could at least give a bit of a leeway and close out if it was going against me without taking a big hit. Because with 24 hours expiry, if it goes against you even just for like an hour, your options are going to be basically worthless if anyone ever decides to do something like that. So it really is whatever I put in is what I expect to lose kind of play for this as well. So I'm not going to go crazy, but I do think it has that It does have that feel about it, that setup about it, that it could be a really, really strong mover to the downside, at least for a day or two. So that's what I'm expecting. That's the anticipation for what happens after the AGM on the 20th of October. And for all I know, you can all come back and have a laugh at me as this breaks to new highs at like $30 or some shit and this whole plan failed. So either way, I'll catch you guys next time. If you like the content, please do hit that like and sub button. I'd appreciate that very much. Otherwise, guys, I'll catch you next time. Have a good one.